We continue our discussion on a sample balance sheet in this particular video. And this is what we had seen, and we had said that in certain geographies, the left and right and top and bottom kind of change, but that's okay. That's not the crux of it. We're now going to look at these individual items and try and understand what we mean by the value of these items as we go along. Some terms may not be very clear at this point of time. That's absolutely fine. Don't worry about it too much because we have a complete unit on only balance sheets at a later point of time that's going to come, right? So don't worry about the terms that are going to get used here. In case they're not very clear, we're going to reassess them at some point of time in near future, right? Let's understand individually each of these sections. The first one that you see is the depreciated value of the long-term assets. We'll come to the term depreciated value at a later point of time, but typically you have what is the non-current assets for your firm, right? You're trying to find the value of these today, right? There are other connotations into this and we will discuss those as we go along, but broadly you are trying to find the value of these today. That's what is called as the depreciated value of the long term. This is the current book value of long-term assets after accounting for certain wear and tear. Let's take simple example. You buy a car for 5 lakh rupees. At the end of the first year, it will not be worth 5 lakh. If you sell it in the market, it will probably be worth 4 lakhs, right? So you'll put 4 lakhs here. That's the current value of the asset that is going to be there for your long period, right? The second part is investments. Now, any investment done by the firm in financial instruments or also other companies, right? Investments now actually get classified in two parts. They could be short term or they could be long term, right? When we look at a particular balance sheet of a company, we will look at those classifications separately and understand. But broadly, if you have excess money that is lying idle at this point of time and you're not really generating any kind of return on that, you can put that money as an investment and probably get some return out of it, right? That's what is called as investments for the financial services for financial any firm's financial statements, right? The next part comes around current assets. Now, current assets typically have three broad components. There could be more, and we will discuss more as we go along. But these are assets that can give you money in less than 1 year, right? They will give money in less than 1 year, technically speaking. So cash and bank balance is simple. That's anyway the money that you have, and there's no real complication around that. Inventory is nothing but the raw materials that you buy or finished goods that you have in your store. So what do you mean by raw material and finished goods? You take the raw material of a car, the tires, the wires, the seats, the metal, etc. You convert it to what is called as a finished good, which is the actual car. Now this car could still be in your showroom, it's not sold, and then you could sell the car, right? Both these raw materials and finished goods are considered as short-term assets because they will basically give you the money in near future for most businesses, right? This part is called as inventory, and hence this is classified as a current asset, right? Then there's another part which is called accounts receivable, right? Now, as the name suggests, this is money that is supposed to be received, receivable. I am supposed to receive it. I have not yet received it. This is the money that the customer owes us, right? Why? I sell something, but I have not yet received the money from that. That's what the money the customer owes us. That's called the accounts receivable, right? That's the second part of the assets that we see, which is the current asset. So non-current asset, investments, and current assets. There are more kinds of current assets that are there, but for now, we are only going to focus on these ones. Then we move to the liability part of thing. We have two parts there. The broad non-current liabilities. First, we will look at what is called as shareholders' equity. The initial capital put in the business by the company or the shareholders is called as capital, share capital. That share capital is capital infused by shareholders, the initial amount of money that was put in by the company's promoters or owners, right? Then over a period of time, the company keeps making money. It can choose to repay that to the shareholders, or it can choose to invest more of that to buy more assets and all, right? All that the profits are retained and not distributed to or among shareholders fall under what is called as reserves and surplus. Remember, we saw the example that if you start with assets of 1 lakh and shareholder equity of 1 lakh, and you make a profit of another 20,000, you can either choose to directly repay this 20,000, but if you do not, and let's say with this 20,000 of profit you buy another asset, let's say a laptop with this 20,000, then total assets is worth 1,20,000. Whose 20,000 was this? This was the shareholders' money. So that goes and gets added here. Tomorrow, if you close the company, you will get 1,20,000 by selling your assets. You will be able to repay that 1,20,000 to the shareholders. That's how the equation matches, right? That's what you see on the liabilities side under owner's equity or shareholders' equity, right? Then you have the non-current liabilities. These are, remember, all the non-current liabilities or the long-term loans typically, right? When we mean long-term loans, these are loans which are for a tenure of more than 1 year, sometimes 5 years, 6 years, 10 years, right? You could raise this money from banks or any other lenders. Anyone could have given this money to you. This is all long term in nature, right? And then you have the current liabilities. What are the current liabilities? These are payables, money we owe to our suppliers and others. Let's say I buy the raw materials. I buy the tires and wires and seats and metal for my car, but I do not pay my suppliers. That's a liability, right? That's what I owe. I have to clear that in less than 1 year. All that is called as an accounts payable. That's called as an accounts payable because I'm supposed to pay that, correct? And then finally, we could have something called as a short-term loan. Short-term loan is any loan that is for a period of less than 1 year, right? Now, why is that important? Is because sometimes the need might be for a quick cash flow requirement. I need some money today. Tomorrow, I might receive money from one of my clients, right? So I might need money for 1 day or 3 days or 5 days. This is typically a short-term loan. That's not a long-term loan, right? So that will get classified here as a current liability because I will borrow this money. I will get some money from my clients tomorrow and I'll repay this money immediately. So the objective is not to keep this money with me for a very, very long period. And that's why it is called as a current liability. So that brings us to an understanding of the overall assets and liabilities side. Now remember, the asset and the liability will always match. Now this is at a point of time, remember, correct? So at a point of time. Let's try a couple of transactions on this, right? Let's say the company raises 100 crore from bank, right? That will be a loan. So what will happen? You will add 100 here, correct? And immediately as you raise the 100 crore, that 100 crore will come in your bank account. So you will add 100 here, thereby making both of these 1600. The balance sheet stays balanced. There is no difference in that, right? Now let's say as a second transaction, the company buys a factory for 150 crore, right? Now when you buy a factory, obviously you're adding plus 150 here, but where are you getting the money for this from? You will pay this money from your bank account. So you will do a minus 150 here. In other words, you have transferred money from one side of the assets account to another side of the assets account. The balance sheet still remains at 1600 and 1600 because this is just a reclassification, right? So any transaction that you do, the balance sheet will always remain balanced. That cannot really go out of balance at any point of time. And that is the primary crux of our understanding of what a balance sheet shows and how do we really use it in the context of our overall understanding of the business, right? That's a balance sheet and that's a sample balance sheet. We'll look at more complicated areas around balance sheet and more complicated definitions of balance sheets in due course of time. But for now, this is enough for our understanding. We'll also look at individual components in much more detail when we look up sample balance sheets from live companies on the stock markets, right? We will look at companies like Reliance Industries, Hindalco Industries, Bharti Airtel, Infosys, and look at their balance sheets and try and understand what do we get from those balance sheets, right? That's it in this particular section. Thank you.